Hello, everyone. My name is Andi Gray, and I want to welcome you to our webinar today on valuations, everything about valuations. I'm going to ask Dahlia to bring up a poll question so that while we wait for everyone to gather, we can get to know a little bit about each other. And I'm going to ask you to please fill in the poll question that you see on the screen and let us know about you. And while you're doing that, my name is Andi Gray. I'm founder and president of Strategy Leaders, and I'll tell you a little bit more about us in a minute. In the meantime, I've got some housekeeping items to go over. So if you have any questions today, please feel free to submit them via the Q&A or the chat. Dahlia and Robin will get them to me and answer them at the end. If you want a copy of today's webinar or you want some follow-up, you can put your email or phone number into the chat window. You can either send it privately to Dahlia, or you can send it publicly to everyone. And as we gather that any of the information from you, as I said, we will go through poll questions or chat questions at the end. And while we're waiting for everyone to gather, just some interesting stats about small business. As I like to say, small business isn't so small, but it is facing some real challenges. In case you didn't know, there's about 6 million privately held businesses in the United States with 2 or more employees and privately held owner-operated. About 3 out of 4 of those get sold, merged, get bought up, close, or otherwise disappear in every 10-year cycle. And what's interesting is that there are as many newcomers as there are exits, so that over time, the numbers of companies operating stays constant at around 6 million companies. Now, let's take a look at the answers to our poll questions. Dahlia, you want to bring up the answers so I can see them? And it looks like the majority of you who are here today are business owners. We do have some employees and some advisors, and then someone who checked others. So I want to welcome all of you to today's webinar. The curiosity that brought you, I hope you'll get some of that satisfied here today. And let's take a look at a little bit more on Strategy Leaders while we're still giving people time to gather. So Strategy Leaders was founded on research based at Columbia University. We've been around for over 25, actually getting close to 30 years now. We have a skilled team of people who are specialists at working on growth and development with the owners of privately held businesses, an entirely unique breed of cat, I will say. We have deep experience in a wide set of industries. We have a nationwide footprint. We work from the East Coast to the West Coast, north to south, and we offer a variety of services, which I will talk about a little bit more in another minute. If you would like to get any information from us, please let us know who you are so we can get back to you. And in terms of ways that we help our clients, we work on building this generation. So we take owners from entrepreneurs to business builders. That means building management teams through coaching and training and advising them, driving growth with sales and marketing expertise that we have on staff, and driving profitability and stability through plans and tactical reports, accountability tools, and the financial tools that are essential: budgets, dashboards, key performance indicators, and what-if modeling. As a reminder, if you would like to weigh in on future topics that you'd like to hear about, please feel free to put that in the chat window as well. Now let's take a look at ways that we help our clients in terms of building the next generation, because that's a large chunk of our work as well. And in doing that, we help with valuing businesses for exit or acquisition, either close to or well in advance of. We figure out how to best sell or buy a business. We help family-owned and next-generation transitions come to be by helping the owners plan and prepare, counseling family members, developing the management teams to actually take the business over, and identifying outside connections when it's important to look outside for a buyer for the business. And we also do help guide successful takeovers once the transaction takes place or is about to take place. So now with that, let's dive into today's webinar and take a look at the table of contents. And here Dahlia is going to launch our second poll question. We'd really like to know a little bit about your experience with getting a valuation, what you're thinking to use the valuation for. And in terms of today's webinar, as you're answering that poll question, we're going to take a look at what is a valuation, what are the roadblocks to getting a valuation, why you should get a valuation, what to look for once you've decided you need one, the types of valuations you might want to consider, and then we're going to give you some case studies to bring it all home. So with that, Dahlia, why don't you bring up the answers to the second poll question?
Let's just give a few more seconds.
Give them a couple more minutes. Okay. So I do like to say that knowledge is power, and knowing your business's value allows you as a business owner to ensure your plans and your goals are on the right track. And without it, it's almost impossible to know for sure. So you let me know, Dahlia, when you're ready to bring up the poll questions. All right, so most of you are thinking about getting a valuation to determine the value for long-term planning. That's wonderful. That's what I love to hear. Some of you are in the process of selling or negotiating with a buyer, so that could be helpful. Some of you are thinking about using it to buy a business. That's great, because valuation can really help you to keep you from making a mistake. So a mix in there, and thank you all for answering that. Now let's go to the next slide. So what is evaluation? First of all, evaluation is a tool to help you. You can figure out where your business stands. You can use it to help strategically move the business forward, and it can serve as an ultimate progress management tool for your business. You can also use it as an estimate of value based on tax returns, financial performance reports, outlook for future performance, and economic and market conditions, and comparative databases. These are all the elements that go into evaluation. And one of the questions I often get on this page is, why tax returns? So tax returns are the only document that a business owner signs in the world of privately held business that they go to jail if they lie on it. So it is the only clear, transparent document that exists for privately held businesses. You can certainly use financial performance reports to round out the picture, and certainly anybody you're working with should be taking into their framework of advice the outlook for future performance and market conditions. And they must be using comparative databases, which we'll get into a little bit more in a couple minutes. Now, in terms of how evaluation is used, it's used to set the fair market value of shares. So what would someone else in the marketplace under current conditions be likely to offer for this business? Or if you're a buyer, what should you expect to pay? It's used to set up goals and plans to move the business forward intentionally. It's used to prepare to buy or sell the business. So as many of you are talking about in your answers to the question, it's also used to support requests for insurance, loans, and share distribution. So if you're thinking about key man insurance, for example, or you're thinking about capitalizing the business, or you're thinking about bringing a new shareholder in, or expanding the role of a shareholder. It's also used to ensure an accurate understanding of the role that the business plays in the owner's wealth portfolio. And I will talk a little bit more about that as we go on here. So in terms of the top 10 reasons to get a valuation, obvious is to better understand your business and its potential. Know the value of your largest asset so that you can plan for retirement. Ensure the business and your family are properly protected. Create a succession plan. Pay the right amount when you buy a business. Get what your business is worth at sale. To create buy-sell agreements with business partners. To explore funding options. To establish a trust or create an estate plan. And to prepare for taxable events such as gifting or grants, where you have to have a valuation in order to file with the state. Now, with all of those reasons to get a valuation, let's take a look at the roadblocks to getting a valuation. And with that, Dahlia, why don't you launch our next poll question as I talk about this slide. So here we're looking to see if you have a valuation for the business and what your thoughts are if you don't have one. Here are some of the most common reasons that we hear from business owners why they don't have a valuation at all or an up-to-date one. It's expensive. I get that one. Historically, the marketplace has charged tens of thousands of dollars for these things. It's not necessary. And your valuation should be in the very low thousands at the most. The second thing I hear is that it's time consuming. So it can take weeks or sometimes months for the valuer to calculate the valuation and get a value back to the owner. It's complicated. There's a ton of back and forth in the traditional business valuation marketplace. The business owner needs to gather forms, needs to go through interviews. The fact-finding process is lengthy. And this all pulls the business owner away from their business. With our valuation service, just FYI, you'll still have to submit some documents, but they're documents that you will have it readily at hand. And you'll find that additional fact-finding and document review is fast, efficient, collaborative, and relatively painful. The last one is not now, and this is one I can't do much about except to try and motivate you. So taking all of these objectives into consideration, it's no wonder that business owners often wait until a life event forces the issue and requires them to have a business valuation performed. So, for example, a lawsuit, a divorce, retirement, death, downsizing. And oftentimes that life event is the most inconvenient time to have a valuation completed, and often leaves it to some other people who aren't qualified to manage the process having to take over. The value that you're giving the people who know you and trust you by getting a valuation done is you're offering them as well as yourself a way to be prepared if and when you need one. So let's review the answers to poll question number 3. So some of you do have a valuation. Some think it's outdated, some it's current. And a bunch of you thought about getting a valuation. I'm glad some of you are here today to think about, never thought of having a valuation. And for those of you, I hope you're learning enough here today to motivate you to go ahead and do something about it. All right. So why get a valuation? These are pretty compelling stats. Business owners don't know what their business is worth. That's what the statistics tell us. And a corollary to it is that most business owners overestimate the value of their business by 50% or more, which can be a real blow when they come to getting ready to exit. I've had more than one valuation come to us from a buyer who has a seller come to the table to get a valuation done and then walks away from the table because they say, I can't afford to sell the business for that amount. You better know that answer early and be working towards the exit value that you need. I will remind you that in most cases, 65 to 80% of a business owner's net worth is the business, but over half of business owners fail to monetize the asset when it's time to exit. In other words, they don't get the deal done or they don't get the value that they should be getting for the business. That's not a risk you can afford to take with the biggest asset that you own. Self-employed people, which are business owners, actually have 3.5 times greater net worth in general than salaried employees. But most of that is intangible. It's tied up in the business, which goes back to the statement above that you got to be able to get the money out at exit. And tied into that, stats say that 40% of business owners have no retirement savings. They're counting on profit from selling, and they don't realize that revenue and profit and building that may or may not equal building value for exit. They don't understand how those two tie together. And especially coming out of COVID, we're seeing a lot of people who have a real high need to recover retirement savings as they've supported the business, or tied in with that, have enough money coming through the sale that they can deal with any idle loans that they had that are obligations on the business. So with that in mind, it would seem to be common sense for all business owners to know all the time what their business is worth. But let me keep going in terms of trying to get you motivated. Without evaluation, it's difficult to know or plan where you are, and nearly impossible to measure progress over time. You might measure progress in terms of, did we make a profit this year? But you aren't seeing whether or not that's moving the needle in terms of building your biggest asset value. I think business owners actually understand the importance of evaluation, because 96% of business owners say they should have an exit plan, but they don't know how to get there. And 87% admit that they don't actually have an exit plan. And tied in with that, M&A professionals will say that about 70% of business owners are not prepared to sell or transfer their companies. I would make the argument that lacking a current valuation is at the heart of all of these issues. Now, let's shift gears and get into some meat here. And we're going to start first with who to look for or what to look for. And here I'm going to ask Dahlia to launch another poll question real quick. This is about timing to exit. Let's get your input on your timing to exit. And while you do that poll, let me give you some suggestions on what to look for when searching for someone to help you with evaluation. First of all, you want someone who's going to analyze factual comparative data, follow professional standards, provide extensive reports, charge a reasonable fixed cost that includes revisions. They're going to offer you insight on the business. They have a well-documented system, and they have extensive experience doing valuations. Dahlia, do we have enough answers on the poll questions, or should we give everybody another minute?
I think we're good.
Okay, go ahead. Let's see about timing. All right, so nobody's getting ready to sell in the next year. That's great. Gives you a little bit of breathing room. There are some of you that are in 1 to 3 year time frame, and I would suggest get moving fast, because those 1 to 3 years can fly by. And you may or may not like the results of the valuation, but it's going to tell you where to look and what to work on to get it fixed and how to fix it fast. 3 to 5 years, 5 to 10 years, you've got a bunch of you in those categories, and an equal bunch in the over 10 years. So those folks, you've got some time to fix things. Start figuring out where you stand and start thinking about how are you going to build this business in terms of having a value that you can compare to the value of the home you use. So you've got an asset value in your home, you've got an asset value in the business, and those are going to be your 2 biggest retirement values for most people, in addition to any savings you have set aside. Now, let's go on to the next question. And this is an example of something to expect. So when you're talking to someone who's going to do valuation for you, you want to make sure they're going to provide you with a data table of the inputs that they're using to put into the valuation. And then you want to know what kinds of questions they're going to ask. So things that we ask about is every part of owner's compensation included? What's it going to cost to replace the owner? Where's the accounts receivable? You see down here that accounts receivable is circled, and that's because it has NA on there. And the reason that it has NA on so many tax returns is because the tax returns are filed on a cash basis, and they're not required to record accounts receivable. That doesn't mean it exists. It should be included, and it should be put into the valuation. And then lastly, we want to confirm our understanding of all assets and all liabilities so that we are giving you a complete picture of what's going on. You also want to look for lots of calculations. So in terms of the inputs, every value that you get for the business should be made up of 3 different approaches: what's called a market approach, an income approach, and rules of thumb. So market would be similar to a comp if you were looking at valuing your house. What have other businesses in this market, in this business, in this neighborhood, what have they sold for? The income approach uses company data to estimate value through multiples, cap rates, discount values, and so on. And then the rule of thumb is based on estimates based on industry rules. So there might be a seller's discretionary earnings times some multiple, for example. All three of these values need to be calculated for each output, and then you need to find the center for each of these values. Now, in terms of the outputs, you want to have 4 different values. So you don't want to get just one value. You want to get multiple values so you can talk with your valuer about which option might be the best option for you. And the 4 values are equity, asset, enterprise, and liquidation. And we'll explain those a little bit more in a couple of minutes. Now, let's go ahead and look at the next slide. Something else that you want to look for from the valuation provider is the ability to play what if. You're not going to get this from every provider, but it can be a really useful tool if you can get it. It's an essential planning tool that helps the seller demonstrate future opportunity and helps buyers to evaluate the risk of what they're buying and demonstrates some meat behind the plans that you have for the future of the business after you hand it over, if you're the seller. Now, some final thoughts on what to look for. Let's just recap this a little bit. You want a clear financial picture of the business based on factual verified data, valuation options based on different types of valuation methods, detailed reporting including explanations, clear data table to review and update, multiple value options, and KPIs or key performance indicators and what they mean in terms of benchmarking your company against its peer group. And then finally, you want to get advice from the valuer about what do you do to go forward. In addition to that, you want to have someone who's using NACFA principles, someone you can talk to openly and honestly, a tool that increases your knowledge and understanding, minimal effort required on your part, and something that can be done quickly at a reasonable all-in cost. Now, in terms of that second bullet, someone you can talk to honestly and openly, that is so important. You can't work with someone who's going to talk down to you, who's going to make you feel like you shouldn't be asking questions or that you don't know what you're talking about. This should be easy to understand, plain spoken English from someone who knows what they're talking about, but doesn't use industry speak to get it across. Now, let's take a look at 4 different types of valuations. We're going to start giving you some comparative data here. These 4 valuations are all the same company at the same point in time, but different ways that the company might be sold. So equity value is what is often called the lock, stock, and barrel approach. So this is often used in family transitions or insider transitions when the shareholders or the people buying in have confidence and insight into the company's financials. Asset value limits the exposure of the buyer and is most common when you have outsiders who are buying the company and includes the company's assets, but not the company's liabilities. Now, in this case, you would pick up access to the website, access to employees, information on the company base, the phone number of the company, intellectual capital of the company, but you would not pick up any liabilities for the firm. The enterprise value is often used in private equity transactions, and this is where it leverages the firm forward. In this case, you see the enterprise value is actually slightly ahead of asset, but below equity value. And I would generally will tell people that if the enterprise value is significantly below the equity value, it's probably not going to be worth pursuing as an option. So we'll give you some private equity feedback there. And then finally, liquidation value is out on its own little limb. This is what the business would be worth if you quickly shut it down, either a planned or an unplanned event, what we call a fire sale. And this figure does not include accounts receivable, but does include retirement of all liabilities of the company. So it does not assume a buyer is involved. All right, now let's look at some case studies. And we have 3 case studies for you today. The first is the same company, but different NAICS codes. You're going to ask me what's a NAICS code. I'll explain that in just a minute. Then the second is which company has more value. We're actually going to let you all take a guess. And then the last is an example of the role of inputs and how that can influence the value of the business. So we're going to start with the first one, different NAICS codes. So this is exactly the same company, same point in time, two different NAICS codes. So a NAICS code is a code that is on your tax return. It's on the first page. It's called the North American Industry Classification System. You can change that number anytime you want by just asking your accountant to change the number. You should be working with a valuer who will do some research on NAICS codes to make sure that you are properly coded. And in terms of the NAICS code, what you want to think about is where in terms of the value behind the business and how much inherent value is the business in, even though there might be businesses in similar categories. So for example, taxi companies versus limousine companies. Limousine companies have much more investment in training and infrastructure typically than taxi companies do. Or piece fuel manufacturer versus a pharmaceutical manufacturer, which has much higher level of technology and again, responsibility in terms of its internal systems and auditing processes. So you want to make sure that you've got the right NAICS code. Otherwise, this value is not going to reflect what your business is worth. If you want more information on this, you can go to the Census Bureau or you can come and ask us and we'll help you with that. The second case study that we're going to go to is which company has more value. And we're actually going to sit on this page for a couple of minutes. Here you see data that goes into building a valuation. I know there's a lot to digest on this page, but let's take a look and let's take a guess as to which company has greater value. So while I take a drink here, I'm going to let you guys look at this. And then Dahlia's going to throw up a poll question to let you weigh in on company one or company two. And if you're not done looking, you can just grab the top of the bar on the poll question and move it off to the side to get it out of your way. So go ahead, take a look at it. And Dahlia is going to tell me when you guys are all ready to weigh in. Now, as you're finishing up your assessment and taking a break for a minute, I also want to encourage you to put your questions into the chat window or the Q&A so that we will have plenty of time for Q&A as we get through today's webinar. And would love to know your questions. We've deliberately made sure that we would have time to answer all kinds of questions. And Dahlia, let me know when everybody's weighed in or if they need more time.
I think we're good to go. I'll share it right now.
So on the next slide, let's give you the results. And I'm going to give you a recap of some of the factors. So company number one, a good chunk of you, company number one actually won. So company number one, let me explain to you why it had more value. Its net income was higher, both on a dollar value, 3.5 times, and on a percentage basis, six times higher on a percentage basis when comparing the two companies. One of the things that took away from value, they'd had no inventory. So that was an asset they didn't have. But they did have 3.8 times more cash on hand. So that added to the picture. They had 4 times greater assets minus liabilities, and they were debt-free. Now that debt-free, I will tell you, is something you want to work on as you prepare the business for sale. You want the business to be debt-free because when you sell the business, after you sell the business, you have to pay taxes on the profits. After you pay the taxes, you have to pay off debts. And when you get done paying taxes and paying off debts, you end up with a significantly lower amount left in your pocket than you were thinking about. So you have to really think about using the resources of the business while you're in business to pay down the debt and figuring out how to make the business work to do that, which is something that we work with our clients on all day long. We really work hard on getting companies that can grow, be profitable, and be debt-free. Now, the second company had almost 2 times higher revenue, which would make you think they're very attractive. And they have 3.5 times greater owner's compensation. So the owner's getting a lot of rewards. They did have inventory added to the assets, and they had more fixed assets, which added to the asset value. Unfortunately, what pulled them down is they had 10 times more accounts payable and 10 times more short-term liability. And that's what really chewed up the value of the business. So again, to the same point, use the business while it's in business to pay down debt, because that happens with after-tax dollars. And with that, let's wrap up here with some final recommendations. And case number 3, here are some examples of questions that you want to ask. How do inputs lead to outcomes? So I get a question a lot. In terms of off the books revenue and income, how does that get counted? It doesn't. And the reason for that is you can't prove it. If you're not reporting it to the federal government, then it doesn't exist. So if you have off the books revenue and net income over the 3 years prior to the sale or the run up to the sale, you want to move that revenue all onto the books. Another question is, what if expenses include owner's compensation? So you want to make sure that anything that is owner's compensation, travel, car, cell phone, anything that goes out the door when the owner goes out the door gets moved to the owner's compensation category. Because in fact, that's something that the future owner will not have to pay for. And as you move that over, you also then do have to figure in though, what's it going to cost to replace the owner? So usually if the business is doing well, it will not cost as much to replace the owner as the owner is actually taking out of the business. That's fine. Just make sure that you adjust that number into the valuation. Where's the accounts receivable? I had talked about that earlier, that on most cash-based tax returns, the accountant doesn't bother to put in accounts receivable, and that's fine, that's appropriate. But when it comes to the last 3 years run up, you want to start putting it on so it is documented. Then are all liabilities disclosed? You want to make sure every year that your accountant is aware of the liabilities, that you're depreciating all of your equipment appropriately, that you've got any write-offs that should be taken are being taken, but I wouldn't get piggy with the write-offs. So number 6, one of the things that I see from a lot of people is that they focus with their accountant on not paying taxes. And yes, you can take tax write-offs and you can avoid taxes, but that does not mean that you have a profitable, productive business. And if you're going to sell the business for maximum value, you have to have a profitable, productive business. So you've got to find the middle ground in there. And if you want to sell the business for a lot of value, you're going to have to pay taxes, at least in that last 3-year run up to exit. And you will make more by doing that than you save by avoiding paying the taxes. There are some other questions that you want to be prepared to ask. So what happens if revenue drops? What happens to profits? And you want to be able to and prepared to answer that. That's certainly something that a lot of people have been having to deal with in the last 3 years as we've gone into and come out of COVID, and we're still talking about that impact. And then how big is the risk of paying off the deal? So the buyer wants to know that they can pay off this deal within a limited period of time because they can count on the net income that's already there. And then they figured out a way to leverage it up by leveraging the business forward. And you want to help your buyer figure out how best to do that without disclosing too many secrets in the process of negotiating the exit. So with that, this is your last slide, folks. What do you do with the knowledge you're gaining? Build value every year in the business and prove it by getting an annual valuation or valuation update, which should be done for minimal cost. Prepare for sale or acquisition by making the business what we call trigger ready. Stuff does happen in this world, and you just never know when you're going to have to sell or when you're going to need to buy in order to leverage the business. Make sure that you can actually get through a transaction if you're a potential seller by making the business trigger ready at any point in time. Then continuously cultivate opportunity. So whether you're a buyer or a seller, build a list of people who might be interested in buying your business or businesses that you would be interested in buying to help leverage your business forward. I've had a number of people who've come to us for evaluation, said they weren't happy with the value, but when we looked at leveraging the business, adding on another business was a great strategy for more than doubling the value of the business. And there are a lot of businesses that are for sale today. There are a lot of baby boomers who are getting ready to get out, and there is money available from the SBA to get these deals done. So it's certainly a strategy that I would encourage all of you to think about. And then when you're getting into a deal, make sure that you do evaluate each potential deal carefully and accurately. Make sure that you know what you should be looking at, get your questions answered, use the valuation to play what if with the business, and then get a deal that's actually going to serve your needs. So with that in mind, ways that we can help are right here on the screen. Executive coaching, valuations, key performance indicators and what if modeling, transition planning and implementation, our core product, which is business growth programs with business plans, and management team development. These are the key things that we do with our clients, in addition to valuations being a key performance tool for your business. So with that, we're going to take some questions, and I would encourage all of you to think some about the questions you'd like to get them answered. We've got time now to take them, and Dahlia, you're going to feed them to me, so go ahead. What's the first question?
Awesome. Great job, Andi. So we do have a few questions. The first one being, what is the typical turnaround time to complete valuation from start to finish?
So for us to do it, we can get them done in under 2 to 3 days if we're really time pressed. We like to say we'd like a week just so we can go through it carefully and answer all our questions, but we can get them turned around in a couple days once we have the data from the client. The client should be able to get the data to us within a day or two of the time that we ask for it. It's readily available financial reports and tax returns, and then a real quick easy to answer questionnaire that we can walk you through. So a week beginning to end.
Okay, great. Another one is, how much should I expect to pay for evaluation?
So that's going to go all over the map. I will tell you our price is $3,500 on the first round, and then in the low 1,000 for updates, depending on what's involved in the updates and how many changes there have been. What we find is generally the valuation is really simple to update once we have the data in place from the first round. I've seen them range up to tens of thousands of dollars and beyond. I don't think anybody should be paying that. I don't think it's necessary. You don't get anything that is more valuable or more useful in that. But it's your choice how you want to spend your money.
Great. Okay. We have one question here. Recognizing there's a lot more to evaluation than this, I was also told typically it's a 3 to 5 times EBITDA. Can you comment?
Absolutely. So that's a false statement. So the value of the business is based on two things: the size of the business, so revenue, and the EBITDA of the business. So in terms of the size of the business, the larger the business, the larger the multiple. The multiple is then a multiple of the EBITDA of the business, but it is not the EBITDA that you see on your P&L. If you in your monthly or annual P&L or income statement reports. It has to be massaged to account for things like owner's compensation and other additions and takeaways from the profitability of the business.
Okay, great. In our industry, is there a typical multiple of net earnings after normalized adjustments that is used for valuation? Also, do you look at it differently buying a standalone as opposed to an add-on to your existing company?
So if you're looking to purchase a business, you want to look at it, you may want to look at it both ways. So what's the business worth? And then how does that bolt on to my business and impact the value of my business? So that would be the example I was talking about earlier, where we've had a few clients that have come to us looking to do an acquisition, and they're doing it specifically because the leverage of the business is going to go so fast to the bottom line. They don't need to all the infrastructure that they had on the first round of growth and development when they bootstrapped the business. And now anything they add on becomes much more profitable. And they can cut out costs as they're bringing that business in under their fold. Can you read that question again? Because I want to make sure I answered the first part.
Yes, the first question he asked is, in our industry, is there a typical multiple of net earnings after normalized adjustments that is used for valuation?
So that would be, if you would, the rule of thumb calculation. So in a particular industry, there might be a rule of thumb, a multiple on earnings. That is only one of the three calculations that needs to be done by the valuer. The other one being the market approach. So the comp on the business, what have other businesses actually sold for in the marketplace that are similar to our business. And then the third would be the calculation of, based on calculations of the facts of the business, taking into account the profitability of the business, the metrics of the business over the last 3 years.
Okay, great. Another question. How early in a company's lifetime should a valuation be performed?
I would say get through the first 3 to 4 years of building. And it depends. So you have to work both backwards and forwards. So you should always be doing a valuation. If you're at least 5 years away from valuation, you should be doing, from exit, you should be doing a valuation every year. At the same time, in terms of looking forward, if you're just starting the business, I'd get 3 to 4 years of experience under your belt and then assess how you're doing at growing that business and growing the profitability and the value of the business. Once you have the business up and running, then I would recommend re-updating your valuation every 1 to 2 years to give your management team and yourself insight into how everyone is doing with building the long-term value of the business. And I have people who are actually using that as part of their compensation plan with people who work for the business to compensate people for building the asset, the exit value of the business.
Great. Another question. How do you consider the valuation if the company has multiple intellectual properties?
Really good question. So there you're going to need an intellectual property expert. So we can put that value into the value, but you're going to have to get someone who is an expert. That is a real specialty industry, and we're going to have to get someone who can do that. If you need help finding someone, we can help you with that. But that does need to get added into the value and may or may not exist on the tax return.
Okay, great. And one more question. If I'm trying to buy a company, how do I have the conversation with the seller that they need to get a valuation?
Oh, good question. So my recommendation, if you're looking at buying companies, is to avoid falling in love with somebody or some company until you know whether you're even in the same ballpark. I've seen way too many times where the seller has an unrealistic expectation of what the business is worth, and the buyer has spent hours and of time getting to know about this business, really loves it, only to find out that there's no way that the buyer and the seller are ever going to get into the same ballpark and be able to get a deal done. So what I would suggest is that you go out and look for people who are looking to sell and say, look, we got a really straightforward process. We want you to get a valuation. If you don't know where to go to get a valuation, send them to us. We'll explain it. And get a valuation done. And then we'll start discussing the business, as long as you and we are both in the same ballpark as to what the business is worth, which if you trust the valuation service and they accept the valuation service, then you're probably in the same ballpark. Now you can start negotiating. The other thing that I would say about valuations is they are the start of the negotiation process, not the finish. So a lot of times business owners will say to me, I can't afford to sell the business for this. But now you can negotiate your way through. What else can you do about it? Can you stay on longer? Can you give something up and schedule it out over time? What you have to look at is, what are all the problems that are trying to be solved by both the buyer and the seller in the negotiation process. Now, for what it's worth, we will be doing our next webinar, I think, Dahlia, is that right? On buying and selling
Yes.
a business. Is that right?
Mhm.
Yep.
Yes,
So we
that's
will
right.
be doing our next webinar on buying and selling a business. So we'll get more into the meat of that kind of negotiation stuff.
As a follow-up question to the intellectual properties.
Yep.
In our industry, what are considered multiple intellectual properties?
So intellectual properties are usually things like, so the best example is Coca-Cola has their formulations locked in a vault. Nobody can access them. Nobody else knows what they are. They're assumed to have great value because without that formula, you couldn't make the product. IT companies, very often their software code is considered to be an intellectual property because it allows them to sell software over time. There is some form of inherent knowledge that exists within the business that is protected, that others do not have access to. But again, as I said, intellectual property is a very specialty driven thing. It is assessed and driven by intellectual property experts.
Got it. Great. Well, I think that's all of our questions, unless anyone has anything else they'd like to throw in the chat before we wrap things up here.
All right. Well, I want to thank everybody for coming. Strategy Leaders, we got a last slide. That's who we are. We would love to talk with you. We're a team of people who look to and live to help business owners succeed with their businesses. And if you have any questions, just please send us an email. Let us know how to get in touch with you. We'd love to reach out to you and help you get the answers that you need in order to be successful with the growth, profit, and development of your business. And I want to thank everyone for coming today.